Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And thanks for joining us again. You know, we proclaimed a breakout last week, Tori. Are we walking that back? Because we have technically had a breakout.
Yeah, we had a breakout of your pattern, right? Breakout doesn't always mean to the upside.
No, and that's been an argument for a while. I mean, when you see something compressing like gold has been doing for the last 6 months, we have seen a breakout to the downside in gold. So we're going to talk about a couple levels. We think we're certainly going to be looking at entry points for gold as it steps down finally to some reasonable correction ranges. You know, we've been talking about gold for a while and how concerning it actually is that after making a $500 increase over the course of November last year until about April, May of this year, that we've only seen about a $200 decrease back down to around $1,900. So we have finally broken below this compression zone that you can see on the chart here. And now it looks like we'll be figuring out where we're going to find landing.
Yeah, a really exciting week. It's almost going back to the March low. It's a matter of timing a lot of times. This is where you build up potential energy, right?
Right.
For that kinetic energy type of an event. And I liken it to a spring. The further down we come, the tighter that spring gets and higher and faster we end up turning around. Now it's a matter of where the bottom is. Picking the bottom is tough because you start predicting monetary policy. You start predicting economic numbers rolling in, the decisions of humans that are pulling strings in a sense. But, we said last week, it feels like it's here and now. And in many instances, it really is.
Right.
And we have a lot to talk about on that. But yeah, this is a welcome opportunity because underlying fundamentals continue to grow, and the justification for owning metals and putting yourself on the gold standard has never been greater. And here's an opportunity to get it cheaper.
Yeah, and before we look at some of the bigger reasons, I do have to ask you, what are the odds we even get to that March low? I mean, you're talking low 1800s.
Yeah.
What are the odds we even get there?
I'd say less than 10%. I can't imagine that happening.
That is your 618 fib. So it is interesting that ended up becoming the 618 fib almost to the dollar prior to us setting the high for the 618 fib. So I love how charts kind of work themselves out even before they work themselves out. So I guess it's definitely possible. We could see a double touch there down at around 1805, 1810, somewhere in that range. But I think 1850 to 60 certainly is a definite, and I'll probably be looking at an entry point there myself and recommending it for some clients.
Yep.
And then if we see that second step down, great. But the likelihood that happens over the course of a couple weeks is pretty slim. That's a pretty significant decline. So the likelihood we get down to that number over the next couple of weeks, I strongly doubt it, just because now we're moving into the geopolitical and the economic things that you bring up. Granted, we're not raising interest rates this month, but we have been promised there'll be another one this year.
Well, to me, it's going to coincide. The bigger question is, are we going to see the dollar continue this spike? So you've got two primary underlying fundamentals driving the
108.
If that's what you're saying, then it could happen. 108 to me doesn't correspond to an 1810, 1820, something like that. 108 corresponds to that 1840 to 60, really. Okay. I think that it'd have to be a breakout above the 108 personally to go down further. And we could see that. It depends on what's going on in the world. It depends on what's going on with other currencies. Again, it depends on what's going on with monetary policy. And it's just a matter of panic. The reason that the dollar can also really rally is when everybody's flying into it. When everybody's selling everything, fleeing into the dollar as a safe haven, whether that's domestically or internationally. And that's like what we saw in 2008 initially when the crisis hit, right? It's what you saw in 2020 when COVID hit. Everybody runs into the dollar. It's what you saw this time last year when everybody was trying to figure out what the U.S. was doing with its interest rate policies, and everybody was moving into the dollar. And we had that spike to 116. That's what would cause gold to do that. So you have that fundamental, then you have the bond yields. The 10-year treasuries are at now a 16-year high. You've got just a beautiful chart on the bond yields. But that's scary. And keep in mind, the higher those go, the more pressure it is on the gold price. The downward pressure. So as they climb, gold should be going down. But what's amazing is that gold has actually remained very strong, even flat through this steady climb, and we'll take it.
Well, not only that, but we're finally, after a number of months, we're starting to see the long-term bonds catch up with the short-term. The inversion of the bond yield curve, where your 1 year, your 2 year bonds were significantly higher than a 5 year, 10, or certainly a 30 year. Well, the 30 year just took a big jump up, and it's now sitting above the 5 and the 10, which it should be. But they're all closing in on that 1 and 2 year, which is certainly the 1 year is flatlined throughout the course of the summer, and the 2 year pretty much has as well. So we're starting to see that, let's just call it reality. We're starting to see reality set back into the markets, where they're accepting that the punch bowl, at least the plan going forward, is that the punch bowl isn't coming back anytime soon.
Yeah, that's more pain for longer. Just like we've talked about interest rates higher for longer. To me, the closer those long-term treasuries get in their yields to the short term, that just means there's going to be an extension of this discomfort, this expensive living, this debt-driven economy, and debt-laden government.
Mm-hmm. And you talk about that rush to liquidity a second ago. Well, look what the equity market has done. I was really hoping to see the equity market take another attempt at that all-time high up around, 36.9 that we got to back at the end of last year. And we just put in our first real legitimate lower low in the equities market all year. First time all year. So the equities market's been pretty flat. We've been trading between like 33 and 35,000 on the Dow Industrials. We just put in our first significant lower low. We broke our first kind of short-term trend line there. And if we start seeing the equities market getting down into the 32 range, we could see 24. I mean, it's not hard to see that type of decline in a very short period of time. Now you're talking an 8 or 10,000 point sell-off in the Dow Jones Industrial Average, akin to what we saw back in 2020 during the beginning of COVID. And it doesn't need that type of event to take place to push it over the edge.
No, that's right. And the equities can't thrive when you've got uncertainty, you've got fear. It hasn't turned into panic yet.
No.
And so that's going to happen. And when that happens, you'll see a mass sell-off. You get all indices and all sectors that get pulled down with it. And then you get the dollar rally. And what happens in that initial period of time is you do actually get a gold price drop. And you'll get a silver price drop, just like what we're seeing, right? So to me, this is an indication of the fact that it's here. We've been pointing to the fall for a while. And to me, it just feels real. This is 2008. And really, quite honestly, you have concerns that have ripple effects. It depends on the market sector that's going to cause the first ripple. And to me, a lot of it has to do with interest rates. And inflation might have been the first thing that caused it all. They let it get away. They have to start raising interest rates and driving up unemployment, or driving down employment is a better way to say it. And that's been successful. Unemployment just spiked to an 18-month high. All right, that's terrible news, but that's the Federal Reserve's objective right now. And so we're starting to see a recession kick in. They wanted a recession. It's here. Well, unfortunately, when you raise interest rates to cool credit markets, to cool the economy, you drive jobs down. That's less buying, whether it's of cars or houses or anything else, but primarily the real estate market has to necessarily suffer. The real estate market, I know we talked a lot about it last week, but your eyes have to be on it. We're at an all-time high in the average home price.
Yep.
Right now, all-time high. However,
and all-time low in mortgage affordability, according
right.
to the National Association of Realtors.
I'm glad you just said that, because we talked about this the other day. Here's what a real estate expert told me. This is the enormity of this situation. Anybody buying a $500,000 house at the previous interest rates of around 3% needed about $5,000 a month in income. Okay. Now to buy a $500,000 house with where the interest rates are, you need over a $10,000 a month income. Same home price, just like what we're seeing, a stagnation in the home prices, double the income necessary to cover it because of the interest rates on that loan.
Right.
Right. Well, it's not just housing. So what's happening now, I talked to another real estate expert. This is not my area of expertise. And he asked me, what do you think's going on in the real estate market? I said, I feel like it's here. And he goes, let me tell you, all eyes on commercial real estate. We've talked about that. The default rate is 5% now, which was 1.7% last year. So we're seeing these commercial real estate loan defaults ramp up. But man, Miles, this guy said that he's closely tied to billionaires in the commercial real estate sector, and there is panic in the streets. Nobody's talking about it. The news isn't covering it. And they have all said that it's going to be 5 times worse than 2008. So if that's going to be 5 times worse than 2008, don't tell me there won't be ripple effects and a dollar rally and a bond yield spike continuing, right? Downward pressure on the equities markets. And that's what recession does. And that's what ends up happening. And the only good news from that is that's the only time we get relief. That's what Morgan said the other day. We only get relief from the expensive living when recessions hit. Prices actually start to come down and you can get some deflation.
Right. At least price deflation. Well, and you throw on top of that the unfortunate reality that while the interest rates are setting up to, quote unquote, cool off the economy, there's a sector of the economy that accounts for about 30% of total GDP that could care less what interest rates are, and that's government spending. So at least 30% of our total GDP, our total economy, couldn't care less what interest rates are. Not only are they continuing to borrow, but they're actually increasing borrowing at higher rates. So we've got this unfortunate push-pull back and forth between the private sector, who is getting cooled off whether we want to or not just in our homes, but also in our equity positions in the stock market, our 401ks, and our paychecks, because the cost of living and the ability to purchase goods and services obviously is getting hit. And those costs of goods and services are going up. On top of that, we've got the government over here who, smaller than the entire private economy put together, but still makes up a massive percentage of our total GDP. They just don't care. There's no austerity whatsoever at this point.
There's no responsibility in the spending or anything else. And the doubling of the gold price is built in. It's a foregone conclusion. Am I saying by the end of the year? No. I don't care if it happens in 1 year or 5 years. The gold price is going to double, and that's a very conservative estimate, right? So that's great. But guess what else has doubled? Our cost of living has doubled in 9 years. So we talked about the fact that, okay, inflation is cooling. So inflation has gone down from 8.5 to 3.5, right? David pointed out that is not deflation, right? That does not mean that inflation has shrunk. It's just growing less. It's growing at a slower pace, but it's still growing. Your cost of living is still going up at a slower pace. Okay, we'll give them the slower pace argument. But if you look at John Williams with shadow government stats and the real measure of inflation, the way it used to be measured during the Clinton administration and before, we have had a 100% increase in inflation in 9 years. 8%, 9%, 10%, 10%, 10%, 9%, 13%, 16%. You add all those up, and we all know it, it's gotten twice as expensive. Have your wages doubled? No. And that's why, to me, the price of gold, it may lag here, but it's coming, you guys. It's coming. Just hold on, buy these dips, and wait patiently.
Yeah, if we see a similar breakdown like we did in 2008, and you're sitting in a liquidity position that allows you to take advantage of the decline in market pricing, you look at what gold did back between 07 and 09, and then what gold did between 09 and 2011. And the way you get to leverage your position back into other markets like equities, like real estate at the end of that is staggering. The percentage gains that you're looking at if you're just patient enough and you look at it far enough back to see the entire picture playing out.
And then you'll move into those undervalued asset classes, right? It's okay. Housing starts down 20%. It's already hitting residential.
Right.
Anybody that says, oh, but it's not impacting residential. Yes, it is. Housing starts down 20% year over year. That's 200,000 homes fewer being sold per month now than just 2.5 years ago.
Right.
And that's astronomical. That's got ripple effects through the economy. That's mortgage lenders and banks and interest rates on the loans and equity being built and people selling and buying and agents making a commission. That has a huge ripple effect across the whole economy. And so it's coming. But again, this is when we get price relief. If you're prepared for a deflationary cycle, if you're prepared for recession, we've told you we've been in stagflation. It's just getting deeper, likely going into a depression. Then you have no fear. in that regard. You diversify, and it may be that silver is the best thing. Those cycles that you just talked about, let's look at silver at 2009 to 2011. I mean, that's when it went and tied its all-time high, going from under $10 an ounce to over 48, 49.
Well, and if you want proof that this is flight capital moving into liquidity, what better example than looking at what gold did today versus looking at what silver did today? Silver still hasn't put in a lower low. Silver is still trending right up against the bottom end of its rising trend line. Now, silver certainly could in the next day or two break down, but you would assume if you're going to have an equities market decline, you're going to have a gold decline. If this had to do with gold, if this whole move in the gold market had anything to do with gold, silver would be down right along with it, but it's not. So what I'm seeing here is exactly what you mentioned. I think this is a mad rush to liquidity that's taking place right now. I think people are strapped for cash. What was the fact we talked about during our meeting this week? And I can't remember the exacts or the dates, but we talked about mortgage lenders are seeing some of the highest refinance rates.
Yes. Yeah, and because the theory there, why would somebody refinance in this type of a market?
Yeah, why would you refinance from 3.5% to 7%?
Yeah, David McElvaney was talking about this, and the reason is you need money. You're pulling out equity while the home price is high prior to a crash.
Or consolidating credit card debt because
Absolutely.
now your credit card's at 15 or 16%.
We're at the highest credit card debt in the history of the United States.
So we have people who are no longer, like we've talked about, able to make ends meet. And this is ends. This isn't vacations to the Bahamas. We're talking about normal cost of living, groceries, mortgage, rent, gas. People are refinancing their lives at twice the interest rate, which means twice the expenses, which requires, like you said a second ago, twice the income. This to me is a last-ditch effort. This is a last-ditch effort to hopefully hold on to see if we can repair the economy enough to possibly maintain interest rates here, maybe even bring them down a little bit. But it's been pretty clear that that's not going to happen. We're getting to the point where if you're not taking significant steps to safeguard what you still have at this point, we said 2 years ago it didn't feel like 2008. It felt like 2005. It felt like 2006. COVID didn't feel like a 2008 market crash. Well, it's been 2 years. It might be 2008 again, right on the corner here.
No, that's exactly right. So I'll tell the listener, if you're trying to sell real estate, lower your price. Lower your price right now and sell it. And again, that's not my area of expertise. I just feel like it's looming. Rob and I were laughing an hour ago because he kind of felt like he bet to the upside that the breakout was going to go to the upside. And he kind of felt like you and I thought it was going to do what it's doing, and that's to turn down. That's okay. That's not important. For all the right reasons, it should have turned up too, because these underlying fundamentals are ugly. It's just that in the short term, Miles, this one feels real to me. Okay, because we're seeing all the metals decline. Platinum's now under $900, which I know you're going to get to. I think that silver sort of has followed gold because the ratio hasn't changed. So silver hasn't had the breakout. It hasn't broken below, which is your point. But I do think it's tracking gold, and I think they're both due for a further decline, in which instance I'd tell the listener, hold on and wait for a really good opportunity here. Rob brought up the point, look, we're 2% and 5% away from key Fibonacci retracement support levels. 2 and 5. That's not a huge number. It's nice in the world of investing to save that much. So, okay, let's see if we can do that. But for you to be acquiring here is no big deal because we're going to blow right past where we are on the way back up. And it's going to be a ride. And to me, it's going to be here, and there's going to be other asset classes that are just getting really sucked down. So if you're exposed to those and you've been stubborn and not lowering your sale price because of comps, go back to my initial comment and understand that it's about the monthly budget. Wages aren't keeping up. And if the price of a home costs twice as much from a mortgage standpoint now at the same home price that it did a year and a half ago, then you have to lower the price of your home and get out from under it if you're in a liquidity crisis.
Finally, since you brought it up, we will take a little gander at platinum because it does look a lot like silver in that it's sort of compressing against its bottom channel. But you're correct. I mean, platinum's basically flatlined, sitting just below 900 again for like the third time now in the last couple of months, and unable to make that step up. So I wouldn't be surprised if we do see gold give us another $50. If we see that happen, I think it's pretty reasonable. You could see platinum give 50 or $100. I mean, we could come back down to some lower Fibonacci levels. That's not completely unreasonable. You could absolutely see silver back down at 20. That's not an unreasonable move down, and it's not an exorbitant move down either.
No. Remember, going back to 2008, gold went down over 25%. Silver went down over 40% when the crisis hit. Okay? Just because the stock market's crashing and housing prices are tumbling and the economy is tanking does not mean your gold and silver is going to immediately be doing the opposite. So you get a little bit of a reprieve. You get a 2 to 3 to 4 week window where the metals prices are going to trace right along with it because the dollar is spiking. Going right back to the start of the show,
Right.
Showing that chart again of what the U.S. dollar has done here in the recent history. Look at this longer-term chart on the dollar that you've shown. You brought this in today. This is really neat dollar action and how the dollar has climbed just over the last few years and what that has meant. We've shown the inverse relationship between the dollar and gold and the way you like to describe it. Gold is a chunk of metal divided by the value or the price of the dollar, right? And yet here we see that the gold price is, relatively flat. It's not like it's going nuts.
Let's go back. Let's give the dollar the benefit of the doubt, and we'll look at this kind of whole move up that the dollar made starting back at the beginning of 2021. So despite that spike that we had back in October last year, we're up about 19% in the US dollar. Now you look at that compared to the price of gold, gold's basically flat. So over that period of time, gold divided by the dollar, that's how we price things, right? Like Captain Crunch divided by the US dollar equals how much you pay for your box of cereal. Works the same with gold. So you look at gold, gold's flat. It's had some ups, it's had some downs, but with the dollar rising as significantly as it has, gold should be down.
Yes.
Or if the dollar hadn't risen, gold is actually up about 18% over the last 2 years. We're just in the first period of time in my entire financial career where the dollar is getting stronger, not weaker, at least on an international scale. And that's an important thing to remember too, because that's also relative when you're looking at the dollar index compared to other currencies. The dollar isn't stronger. It's getting slightly less weaker. It's not 7% stated inflation, it's 3%. That's still 3% a year that it's getting weaker, at least in terms of purchasing power. It's how is the dollar relating to other currencies. And I think that's why you're seeing gold hold its own despite an almost 20% increase in the dollar over the last 2 years. Because you look at the dollar in terms of Japanese yen, you look at the dollar in terms of Chinese yuan, or in terms of euro, or in terms of Russian rubles.
Yeah, no, that's why it's at an all-time high versus the yen. But gold doesn't just respond to the dollar. It's measured in dollars here domestically, but it's also about interest rates and the stock market and the bond market, and the U.S. dollar strength is part of that, right? Geopolitics, the banking sector, inflation, debt, deficits, recession versus depression, energy prices, real estate. All of those have an impact on the metals prices. People say, well, why isn't it going straight up? Man, this is a major tug of war in a strong dollar index, not strong dollar index market. This is what gold should be doing, and we'll take the opportunity to add to ounces.
So thank you again for joining us this week, and definitely to our clients. You know, Tori, I was not surprised. It's been a little quiet the last week or two as gold was trying to figure out a decision. And as of this morning, gold made a decision, and so did a lot of my clients. We've had a very busy day today so far, and I appreciate that our listeners and our clients are learning and putting into practice what they've learned about how markets move over time and looking for opportunities going forward. So if you'd like to do the same with your personal portfolio, and if you haven't reached out to us before, we encourage you to do so. You're welcome to give us a buzz. We can be reached at 800-525-5555. 9556. You can find us on Twitter at ICA Gold, and we're on Facebook at McIlvaney Financial. And as always, you can swing by our website at mcilvaney.com. Thanks for listening and have a great week.